This is either going to be my best investment or my worst investment and nowhere in between. Today I'm looking into Medical Properties Trust. This is ticker MPW, a really popular medical company REIT that has been taking a beating recently. For those of you that aren't up to date with everything that's been going on, it has dropped about 80% within the last couple of years. Really, really terrible price return. The dividend was cut at one point. And all in all, it's an extremely risky purchase, but it is extremely beaten down. And I do think there's a little bit of room for this thing to bounce back. And we're going to go over why. Now, full transparency, I don't own this one currently. I do have it in the $1,000 dividend account challenge, but I don't own it in my personal account. And I'm considering buying in just because of how over destroyed this thing is. So I'm going to take a look at it today. We're going to go over a couple fundamentals of the company and see really if this thing is as bad as everyone says, or if there's some potential for growth. One interesting thing to note is that MPW is actually up about 20% in the last month. It did hit bottom at a little over $3, which is wild to think about because 6 months ago this thing was $7.50, but they did have one significant drop within the last couple of months, and that is when they dropped 29% in one day due to some news about one of their tenants having some issues. And not only is it one of their tenants, but it's their largest tenant that they have, which is why it's such a big deal. That's why this REIT is so affected by this singular tenant. If we keep zooming out even farther, 70% in the last year. It is wild to think that this thing was $13 a year ago. Absolutely insane. And the 5-month chart, even worse. At a high, this thing was trading for $24. Their max chart, they've officially become negative all time since they started trading at about $11. And they just look at this steep decline. It actually pains me. And looking at this, I would say, why would anyone ever consider buying this? But to be honest, there are some good things about the company. It has a 52-week low of 292 and a high of 1314, which is crazy. Their dividend yield is 15.54%, which leads into the next thing we're going to talk about, their dividend yield. It's really interesting how their history has been, but we're going to go ahead and take a look at that right now. Jumping right into Seeking Alpha, one of my favorite places to research dividend stocks, we can see the dividend cut I was talking about where they cut it from 29 cents to 15 cents. So a really heavy cut, over a 50% cut for a dividend. So when it comes to stocks that are known for their dividends, this is always a terrible sign. It may be a justified thing that they had to do, but it's always a bad sign for the company overall, in my opinion. And you can try and convince me otherwise, but I'm not sure I'm going to listen. No, of course I'd listen, but still, it's not a good sign, especially with this instance, with everything that was going wrong with the company. All that this did was push the price of the stock farther down. And prior to this, they were doing relatively well. They had some good growth. We can see since 2014, they had grown it relatively significantly by about 8 cents per quarter, which is great. And if we go to their max chart, we see that they did have a cut in the 2008 era where the housing market, everything was going down. So of course, we would expect that for a REIT, but this is actually now paying a lower dividend per amount paid out per quarter than it ever has been. Because when it started paying in 2005, it was still paying 17, and now it's currently paying 15 cents. So the dividend history was good. It really was, and they're going to have to restart. So if we look at the dividend growth, it's going to be negative. They're actually negative, of course, because they cut their dividend. So the CAGR for the 10-year, still positive, actually, but the 5-year, 3-year, 1-year, all negatives. Now, dividend yield-wise, their 4-year average yield is about 9%, which is a little low now, even because of what's been going on and the price drop. But still, everything else, their forward dividend yield and dividend yield TTM is actually up, which I like to see and has good ratings, but it's definitely a risky stock because if we go down here, we can see the dividend yield is 16.17%. So the yield is wild. So what my plan is with this, if I do purchase this, I'm going to not reinvest the dividends. I think it could be too risky to reinvest the dividends, whereas if you just want a higher yield, pull that money out and put it into a safer dividend stock, a dividend ETF, then you'd be more set. But the company overall is looking better safety-wise, of course. Even though they have all this bad stuff going on and they've cut their dividend, now that they've hit this low, I think they could have some bounce back potential. The payout ratio is sub 60%, which I love to see and is a really good sign for the safety of the stock. But they're going to have to restart with their dividend growth like we thought. So all in all, it is a really high-risk option. But let's go ahead and jump into the next category. Really, really important factor when it comes to these REIT companies is their website. This is where they attract investors. It shows that they're putting in effort. And with some other companies, like some of the Gladstone stocks I did some research on, I really didn't like their websites. So looking at MPW, they did a really good job. I honestly love the color green. Maybe that's why. But looking at the total value, we can see they have a $19 billion portfolio value. With properties, they have 441 properties, which is pretty insane, and then split between 10 countries, 44,000 licensed beds. Now, one thing I want to talk about, that Joseph Hogue, which he has the channel Let's Talk Money, really, really good channel. I like watching his stuff, but he actually talks about MPW. And I believe it was him who said that it would be tough to believe that these countries are going to just let hospitals go under. That's part of what makes MPW more desirable, in my opinion. They would at least let them be purchased out. These are not going to be just vacated facilities, because a lot of these areas, they can't afford to lose hospitals. I mean, depending on where you're from, some areas don't have access to an insane number of hospitals and are not competitive in the hospital game. So it is something to think about when you're looking at REITs and what you're interested in. And I like MPW because it does add some diversity to my portfolio, even some diversity within REITs. So I'm genuinely extremely curious to see how this one does. But if we scroll down, we can see that they have acute care hospitals, behavioral health facilities, inpatient rehab. So tons of different things, primarily in the U.S., which I like, because it's easier for me to follow the U.S. news and whatnot when it comes to the stock market, because I am a U.S. citizen. But United Kingdom, 20%, which I think is a pretty good spread. I wouldn't hate it if they had a little more spread out between that, but Germany, Switzerland, Australia, Spain, so a good amount. And then state-wise, so Texas. Okay, here are the big ones. You want Texas, California, and you want Florida and New York. Usually are the ones that you want big, because there's a lot of money in those states. California especially, I mean New York too. But Texas, definitely looking good. And Texas and Florida are growing states. California is shrinking a little bit, last I checked. So it is good to note all of these things. But Texas 10%, Florida 7%, California 6%, Massachusetts a pretty good spread. And then they have 20% between 26 other states, which I think is really, really nice. Their US portfolio is 11.8 billion. So they do have, what would that be? Let's see. 7 point something billion, because 19 is the total, 7.2. So definitely interesting. And we can see just more information on their website. It's never bad to go through and check out these websites. There could be a little bit more, the investor relations area. You can go through here and check out their information and everything, quarterly results and stuff. I like to go through that, but I do like just looking at their portfolio and seeing what they're saying. Now, one thing that's important to note is the company is not simply just dying. On their homepage, I don't know how to, there we go. They have this video. And so this guy is the CEO. They put out this video. Now, they did put it out when the stock was above $5, so it has continued to fall, or I think it was above 4. But they did put out a nice video saying, please, we know it's scary, we know what's happening, a lot of interesting information, but just kind of like a video like, please don't abandon us. We appreciate you, stockholders. We're going to fix this, which every company puts out, because otherwise the whole stock would tank even more. But I thought it was a nice touch. I thought it was relatively well done. The sound was a little bit off, but besides that, a good video that I think shareholders would want to see. So if you're curious, go check this out. I'll actually link MPW's homepage below so you can go watch it for yourself. So I'm going to actually look in Finviz for a second and show you guys. I like to go to Finviz because they just have a ton of information right at your fingertips. You don't have to pay anything for it. And so we can actually see that there's some really good information down here. I like to skip quite a bit of it, but check this out. So insider ownership is low. Definitely something that is scary, because it's at 1.7%, which is really, really low. I do not like that one bit. It does not give me a lot of faith. But institutional ownership is at 73%. I don't know if this is because most of these institutions are just holding even through the losses. I don't know if they're going to use it as a write-off and sell at the end of the year. I have no idea. I don't know if retail pulled out completely. There's a number of factors with that, but I'm just not sure overall. Now, something that I really want to talk about is the shares outstanding, 600 million, shares float, 600 million. Short float is high, 35%. So they are banking on this stock going down. People do not have faith in this stock, which can get you some crazy gains, but is high risk. They're 70.6% off the 52-week high, and the RSI is actually at, let's see, 60. So RSI is a way that you can tell if something's overbought or oversold. Typically, if it's above 70, it is overbought, and if it's under 30, it's oversold. So I'm surprised the RSI is still so high. I'm curious to see what it does over the next couple months. But I wanted to jump in here and show that the volatility is high. Target price for Finviz is $4.78. I could see that happening, but they do have quite a ways to go before then. So now let's jump back into the MPW website and look at their financials. So everyone knows when we talk about MPW, we need to talk about Steward Health. This is the tenant that is basically destroying MPW as a company. And now this is the flaw of MPW. They were over invested in this one business because Steward is dragging them down. MPW actually put out a report, this was from October 2023, of what is going wrong. And so just a quick update from what I found on the internet. Let's see. They basically were bailed out. They received $675 million in government funding. That was reported by Bloomberg in 2020, but still saw a net loss of more than $400 million that year. Now, they also owe about $50 million in unpaid rent and are being accused of not paying for work done at certain facilities, which is not good. And then on top of that, MPW agreed to fund them a $60 million short-term loan plus a second lien on Steward's managed care business. So, it's rocky. It's rocky at best. We can see here, these are the properties that the real estate investment percentage of gross Steward investment. So this is just of the Steward investment. 77% of it are these 34 facilities. Huge. And their investment is $3.3 billion. So now this was what, a $19 billion company? So this is not a small stake. This is a huge amount for this company. And looking down, some of these facilities aren't even operating. We can see one is being repaired. One is being built, construction date in Texas. So this is what they're investing. This is what Steward is doing, and they've invested in it. So it is tough. And then they go over Steward's investment. Okay, MPW's quarterly supplemental. I'm going to try and keep it as interesting, try and get all the information that you guys would want. There's a lot of info in here, so I'll link everything down below. You can go check it out yourself if you want to go read through it. Now we're going to start off with their debt summary. So mostly fixed loans, which I like to see. A couple variable that are probably hurting them a lot more now, but as rates fall, should do a bit better. Now the problem is that this variable loan is at $1.35 million. So that one is killing them right now as rates go up. But they are fixed at just under 7%. It looks like that's where their range is. So it could be worse, but this one's a little over 7. But all these fixed ones are so significantly low, which is really, really important. I do love to see that. And these are the more recent ones, are the ones that are variable. So it is interesting to look at. But total outstanding balance is $10,200,000, weighted average rate of 4.041%. A really, really, really low rate, which I really like to see. I don't even know if we're going to get that low again, but we can see 15% of it is variable. That's a little bit high. I would like it lower. So for those of you that don't know, real quick rundown, fixed rate is when you buy a property, when you take a loan out, the rate in which you're paying to borrow that money stays the same. It stays the same as when you purchased it. Variable follows and tracks the market. So variable can actually be a better option. It's just significantly higher risk because you never know where it's going to go. You never know what interest rates are going to do. So we can see their debt maturities. They've got some coming up. We got the 10 mil totals, senior unsecured notes, loan terms. I wish they had more secured percent of total, and just a lot of debt, which is tough. But when you have this many properties and whatnot, it's hard not to accrue a lot of debt. And so just like all the other REITs, guys, Realty Income is one of the best REITs on the market, and it is beaten down like 20-25% because these interest rates are so high. It makes it harder for them to buy properties. It makes it harder for them to maintain their properties. It makes it harder just overall for REITs, which is why I'm buying pretty heavily into the REIT sector. Not financial advice, but it's just what I'm doing because they are so beaten down, and if rates drop, they should do relatively well. Now, lien and loan maturity schedule, some more portfolio information. Like I said, you guys can go check this out if you would like to. And then here is assets by type, which we already looked at, care hospitals and whatnot. So 194 general acute care hospitals, behavioral health facilities. I like hospitals. They are probably a bit more to maintain, but they're harder to close because you're definitely losing a hospital is a big deal, like I was saying earlier. And then also the problem with hospitals is it's hard to get a different tenant in. Hospitals are not just open and closed willy-nilly. I don't know if it is different in different areas, but from where I'm from, it's very, very uncommon. So if you lose a tenant, it is really difficult to get another tenant in there. Portfolio information, as we saw, we see with Steward Health, the 36 properties, pretty significant amount. But the problem is that these properties are worth a lot of money as well. Then Circle Health. So here's the thing. They do have a lot in Steward Health, but Circle Health is a huge number too. So if Circle Health were to do negatively over a couple of years, it would look really, really poorly, and I wouldn't like to see that at all. So I wish they were a little bit more diverse in their financials. We can see Priority Group is the same number of properties, but significantly less money. So it is really interesting, but overall Steward Health is what, 20% of their overall outstanding tenants. So it's that's why everyone's freaking out. People are selling off for a really good reason. It is scary. It is really scary. And so if 1/5 of your business might just be gone, that's something that could kill you. But is it going to make your stock drop 80%? Apparently. But that's why I think that there may be some undervalue to this stock. So again, rent coverage, pretty decent. They do well with their hospitals. Total portfolio is looking pretty decent. And then again, more information. I'm not going to read through all of these numbers, but there are some good graphs and charts in here. And guys, if you need to get familiarized with this stuff, I recommend it. If you're going to be investing for the long term and whatnot, take a look at these, try and read them, try and understand what's going on. And that will be extremely helpful for you in the long run. Now we can see their net income, probably one of the key factors here. In 2023, in September, they had 117 million. That's for the 3 months and 9 months end. So again, some more charts and graphs. I'm actually not going to go into all those. Current, let's see, consolidated balance sheets, unaudited and audited, and boom, we see that 19 billion in liabilities and equity and in assets. So depending on the way that you look at it, they do have a good amount of money saved up. The properties, here's where I think that it's going to be okay for medical properties, and it's really the only reason I'm even considering buying, is because the properties still have value. It would be difficult to get a full new client base for 20% of your total tenant, but it's not impossible, and I think that they could at least sell the properties and recoup some of that loss. That's at least what I think. Again, I'm not an expert in this. It's just from reading these financial statements. Overall, it's not bad. Here's the website. If you guys are interested, you can see all their information. If you guys found some value in this video and you want to learn more about stocks, money, dividends, please consider subscribing. And of course, like the video to let me know you like this content, and I will see you in the next one.